Hello and welcome. In this video, OJM Director of Financial Planning, Michael Lewellen, discusses the rising cost of long-term care and factors affecting the important decision to purchase or not purchase long-term care insurance. OJM Group partners are the authors of 12 books written specifically for doctors, including our newest book, Wealth Planning for the Modern Physician, Residency to Retirement. To get your free print copy or ebook download, text OJM Web to 844-418-1212 or click the button below.
Thank you for joining us today. My name is Michael Lewellen. I'm the Director of Financial Planning at OJM Group. And today we're going to discuss long-term care insurance and what is the cost of having or not having long-term care coverage. First, let's take a look at the current state of the market. Traditional versus hybrid coverage. So traditional coverage is what the insurance industry really started offering in the 80s, and it was much like disability insurance today. So there would be a stated daily benefit, and if you were to have a long-term care need, then it would pay based upon that. If you didn't have a need, then it would not pay anything upon your death. So it was a use it or lose it. What happened is the insurance industry did a terrible job of pricing and anticipating with some of their assumptions. And really what's happened is the insurance industry is almost totally pulled out of the traditional market. There's some carriers out there going to have $1 billion loss. And those that are still offering traditional coverage, what happens is that it's just priced really, really high. It just doesn't make a lot of sense, but it still exists. If you have a traditional policy, it probably is adequate and it probably is good. Even if someone told you when you bought it that that wasn't that good of one, it's probably a really good one now. That's something certainly we'd be happy to take a look at for you, but you're probably pretty good. For my clients that purchase traditional coverage, it's better than what's out there today. Hybrid coverage is the use of life insurance really to provide that long-term care. So there's really two types. One, you could purchase a traditional death benefit product and have a long-term care rider. And with that rider, if something were to happen, you had a long-term care need, then you could use that death benefit. So if you have $1 million policy with the long-term care rider, you essentially have $1 million of long-term care as well too. Hybrid coverage is a little bit different. It's still a life insurance product. It's what they would call an asset-based product. The death benefit is still on there. It's going to be a little bit lower, but you're going to have a rider that, for example, you could have it structured in a way that if you were to have a long-term care need, you could pay $10,000 a month of benefit, and it could do that for life. You could have it pay for 5 years, 6 years. There's different ways to design that. So we'll take a look at that. In our example that we're going to look at today, it's going to be a hybrid example, just because that's just what's more feasible. It makes more economic sense today. Do you need long-term care coverage? It's really, it can be, a lot of people struggle with that. I think, from a statistical standpoint, you can see there's 70% of people turning 65 will need some long-term care service in their lifetime. Now, that could be obviously drastically different. For people, it could be a really long time. It could be a shorter amount of time. And then what is the cost of having or not having long-term care coverage? And that's really what we're going to take a look at today, because there's a lot of people out there that don't have it and don't feel that they need it. We're going to look at that from an economic perspective and analysis. But first, let's take a look at what is the cost. And we're looking at, Cincinnati, Ohio cost of long-term care. If you go to New York, it's going to be more expensive. If you go to California, it's going to be more expensive. In the Midwest, in the middle of the country, it's going to be pretty close to what you're seeing here from that standpoint. So you can see, home health, adult daycare, that's drops off the adult daycare, but home health, assisted living is going to be in that, almost 5,000 range. And that's in today's dollars. It's inflating at about 5% right now. So you can see those amounts go up. If you look at nursing home care, obviously that's much more expensive, but you're getting, obviously, generally in that scenario, all your meals and, everything that comes along with that as well too. So you can see, just from a projection standpoint, from 2020 to 2050, just the increase of the cost there from that standpoint is pretty substantial. Now let's take a look at our example. So we have John and Jane Smith, both 55 years old right now. They're going to retire at age 63 and then have 30 years of retirement. So they're going to live to age 93 in our example. Retirement income of $13,000 a month. That's in today's dollars. And we're inflating it at 2%. So it'll be a little bit higher in 8 years when they retire. We are including their projected Social Security benefits to cover some of that cost as well too. Now, if you look at assets, what they have currently, they have 1.5 million in 401ks. They're contributing between employee and employer $33,500 a year. They also have, between the two of them, $500,000 in IRAs. And then in a brokerage account, they have $1 million and they're contributing $30,000 a year. So we're assuming that those contributions are taking place now up to retirement. The assumptions, we're assuming a rate of return of 6% pre-retirement, and then a rate of return of 5% during retirement. So dialing back that risk when they get into retirement. Okay, so let's look at our first example here. The first example is John and Jane don't have coverage and never need it. So they decide, we're not going to buy it. We're going to self-insure, and they win the game. In this example, they're just as healthy as all 4 people in that picture for their entire lives. And they have ending assets value of $3.6 million. Now, this isn't factoring in their home. This isn't factoring in any other real estate or any life insurance that they may have. This is just those assets that we were looking at. So the IRAs, the 401ks, and the brokerage account. But they have, again, they have an ending asset value of $3.6 million, a nice cushion for their scenario. Let's look at another example. They don't have it, so they decide not to purchase long-term care coverage, but do need it. So in this example, a need of $8,000 a month of long-term care expenses start at age 85 and last to age 93 or to death. Now, you may note that $8,000 at their age 85 may not have covered all of the different scenarios. I'm assuming that some of their lifestyle, some of their retirement income is covering some of those expenses. So we're not, they're cash flowing a little bit of that. So the long-term care insurance isn't trying to fully fund what may be their actual need, because it's a balance in between there. The long-term care expense is covered from assets. So we kind of hit on that. They decided to self-insure. So they don't have any coverage, so they're having to pay for it from their assets. And you can see a pretty substantial difference, right? Ending assets values of $273,000. That's a decrease of $3.35 million. So they made the decision to self-insure. They took on the risk, and this is both sides of the coin. So the one side is you end with $3.6 million. The other side of the coin is you really or almost have nothing from an asset standpoint upon your death in that scenario. So again, kind of the risk reward of self-insurance. Now let's look at our third example. They have long-term care coverage, so they decide to purchase it and they use it. In this example, same thing. They have a need of $8,000 a month of long-term care expenses at age 85 to 93. The need is covered with long-term care insurance. Now, I accounted for the cost of purchasing the long-term care coverage in the analysis. So it's a true, apples to apples comparison. So we reduced the brokerage account essentially by the amount needed to fund the long-term care insurance. In this scenario, they have it and they use it. Now their ending asset values go up to $2.63 million, almost $2 million more than the self-insure when they needed an option. So you can see, the insurance is doing its job, right? It's protecting your assets in this situation. Now let's look at a fourth option, right? They have long-term care coverage and they don't use it, right? That's what I get from a lot of people is, I'm just worried about if I have it and then I don't use it, right? What am I losing there? Well, remember with the hybrid coverage, depending upon, really either option that you use, there's going to be a death benefit. So in this situation, John and Jane, neither one of them have a long-term care need. They were, again, extremely healthy, lived their whole lives, never had one thing, and at age 93, on the same day, they both left this world. And what did they leave? They left $2.89 million, almost $2.9 million. And that is including the death benefit from the unused long-term care. So we added that to the asset value there. So when you look at it, I mean, truly, the insurance did its job. It lowers the ceiling on what your assets could be. So it reduces the risk, but it lowers the ceiling there. Now let's look at all four of these examples together. I mean, obviously, as we said, don't have it and never need it. That is the riskiest option, but it has the highest ceiling. So some people may say, hey, I'm willing to do that. I'm willing to, take the risk and use my cash flow. I'm not really worried about leaving anything for anyone, or I don't care about having a cushion. I mean, they're leaving something for is one concern, but if you look down here in the second example, leaving 273,000. I mean, if you live a little bit longer, you're going to start running the risk of running out of assets. So there's one component of not leaving anything for your estate, but then there's also the component of potentially, if you live a little bit longer, running out of assets as well too, from that standpoint. But you can see, I mean, that's the difference. I mean, it is, a $3.3 million swing from that standpoint. If you have the coverage, you end and use it, you're left with 2.6 in our example. And if you don't have it, you're left with almost 2.9 million. So it really comes down to what is your level of risk? What are you willing to take on? Is the difference between option 1 and 2 worth it for you? Are you open to that, to taking on that much risk? Or would you be more comfortable with, well, if I need it, certainly I'm going to be left with more in that scenario. And then if I need it and I don't have it, the difference between 2.9 and 3.6 million, versus the risk of option 2. And there is no wrong answer really in this scenario, because in all scenarios, they're left with assets at the end. Now, again, we talked about if you live longer, there's a risk from that standpoint. But it really comes down to your risk tolerance and what you're willing to take on and what you're comfortable with. Personally, from a planning perspective, as my background, I like options 3 and 4, certainly. But everyone is different from that standpoint. There is no right or wrong. I tell people my job is to educate my clients and to put them in a position to make an educated decision. If you would like that done for you, if you would like to have an analysis done around long-term care and really kind of look at these 4 different scenarios, that's something that we would be happy to do for you. We appreciate you taking the time today and watching this video. I hope that we're able to be a resource, and I hope that I speak with you soon. Thanks.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,500 physicians, businesses, and individual investors throughout the country. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. OJM Partners have authored several books, all of which are available to webinar viewers at no charge. You can get a free print copy or ebook download by texting OJM Web to 844-418-1212. You can also visit ojmbookstore.com and enter OJM Web at checkout. In addition to a free book, OJM Group also offers viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule a free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.